Hi, Rick. How are you? It's been a while.
Albert, it's nice to visit with you virtually. It has been a while.
It has. It looks like you're in Vancouver right now. How's it up there?
We are. It's one of those beautiful Vancouver clear winter days, crystal clear and beautiful. So today it's just absolutely spectacular. As you know, Albert, this is a beautiful city, particularly when you can see it. Today is one of those wonderful days when you can see it.
Yeah, it is. Many days up there myself, so I know exactly what you're talking about. Um, I wanted to talk to you today because we're less than 2 weeks away from the annual New Orleans Investment Conference. And I just wanted to get your thoughts on the markets and talk a little bit about the conference. It's October 19th through 22nd. And this, as we were just talking about, is going to be a fully hybrid conference. And I want to tip my hats to the organizers who are doing this under not the easiest circumstances, with obviously what we've had with the pandemic and lockdowns, but also hurricane that came through. They're really being tested. But the word is everything is back. Facilities are restored. Everything's looking good. Many folks have registered. We have a great lineup of speakers. I'll be there. You'll also be speaking virtually this year, but a lot of people will be there in person, including Ron Paul, James Grant, James Rickards, Jim Iuorio, and Jon Najarian of CNBC, and Peter Schiff, who's a great regular draw there. So thoughts on the format, Rick? It's been a while since you've been to an actual New Orleans conference. I personally am very happy to be going back again in person, and I hope a lot of people come and join us for that. Your thoughts on the conference?
Well, I'm sad myself that, among other things, cross-border difficulties and my own lack of courage prevent my being there. What really attracts me to the conference this year is I think it's so timely. I personally, with specific regards to precious metals, believe that the wind is in the sails of precious metals. And in addition to the fact that precious metals, I think, go up, the price of precious metals equities relative to the metals themselves are cheap. I think the ability to buy asset classes that you want to buy when they're on sale is a rare gift. And the New Orleans Investment Conference, among other things, going back 40 years, has been primarily a precious metals and precious metals equities conference. So I think this year, irrespective of format, it's going to be a particularly advantageous time to absorb and act on information.
That's a very good point. I mean, we finally have inflation rearing its head, people acknowledging it. And as you pointed out to me in the past, this began as sort of a hard money conference. It has its roots in calling out inflation and the value of stable, reliable money during those times.
And certainly there is a diehard constituency in New Orleans, a group of attendees who, by the way, make the conference so much fun, who have been attending for 30 or 35 years, veterans both of precious metals and contrarian investing. I think this year, in addition to enjoying themselves in New Orleans, and by the way, they've been good at that for a very long time, they're going to be rewarded for going to New Orleans because the asset class that they are interested in is simultaneously cheap and out of favor. I think this is going to be a spectacular event this year.
What do you think? You talk about mining stocks and whatnot. Is this a discussion on commodities? Is the primary driver sort of the cyclical nature of the commodities, or is this inflation story become really significant in your mind?
I think you have to segregate between precious metals and other classes of commodities. From my point of view, and you and I have talked about this before, Albert, there are two different bull markets going on. The precious metals bull market, I think, is very much a story around what you would call inflation, what I might call the combination of the deterioration of purchasing power of the dollar and negative real interest rates. I personally wouldn't feel so bad about 5.5% inflation if I was getting paid 8% on my savings. But the idea that I'm suffering through 5.5% depreciation on the currency, and I'm getting paid 1.5 points in interest on the US 10-year Treasury, means I have to look elsewhere. And traditionally, in circumstances where savers and investors have been concerned about the purchasing power of their savings, that is, real interest rates, gold has done well. Interestingly, there have been points in time in the past. 2002 was one of those times. Certainly 1975 was another of those times when the circumstance that we find ourselves in today was true. There are historical parallels where there have been negative real interest rates, but because there was an increase in the nominal rate, that the dollar increased and gold was weak, even while the wind was in precious metal sales. If you recall back to those two prior examples, Albert, you may be too young, but certainly in 1975, the gold price had run from $35 an ounce up to 200, six-fold move in 5 years, got lots of adherents. Then we had a raise in US interest rates, so the gold price fell from $200 to $100. Of course, shook out all the faithful as the things they wanted to buy got cheap. They lost their converge to own them. And the people who got shaken out missed a move in gold from $100 an ounce to $850 an ounce. Similarly, 2002, we had a mini rally in 2001. Gold rolled over, although there was a rise in nominal interest rates, but not a rise in real interest rates. Inflationary pressures were taking hold, or at least the belief in inflationary pressures were taking hold. And those people who missed out on that dip, who got shaken out in that dip, missed a move in the gold price from something like $330 an ounce to $1,950 an ounce. So the circumstance that we're in, the malaise around gold prices, and the clobbering the gold equities prices have enjoyed, if that's the right phrase, I think has real historic parallels. And I draw particular pleasure from my belief that history will repeat itself in the same fashion. I think that by the way, Albert, I'm not saying that gold can't or won't go lower in the interim and that gold stocks can't go further. I'm not a technical analyst, but the chart around the gold equities violating the 200-day moving average and everything down to the downside, I think the sale that we're in likely goes further. But I'm grateful that towards the end of my career, I get the opportunity to stock up again on an asset class that I think will do well. With regards to the rest of the commodity complex, the story is very different, I think. The story there has been a systemic underinvestment by society in the means of production around a whole range of industrial commodities, including some big ones, copper, oil and gas, stuff like that. And it takes a very long time to correct these periods of underinvestment. So as an example, in the copper business, society is living on deposits that were discovered 40 and 50 years ago, put into production 30 years ago, and they're long of tooth. If you look at the ages of the major deposits, Grasberg, 40 years, Chuquicamata, 110 years, Teniente, 100 years, Bingham Canyon, 100 years. Replacing these things is going to be no easy task. And as long as the global economy doesn't absolutely go into a swoon, we're going to experience systemic shortages in basic commodities. Systemic shortages. I think that's very interesting. In oil and gas, of course, there's a different explanation. Oil and gas, it seems, is out of favor. And the consequence of the decline in demand that was experienced during COVID and the fact that capital has become very short in the oil and gas business means that there's been a real dearth of sustaining capital investment, new project investment. And that's been borne out in the market. You'll recall, Albert, we were talking in March of this year when the oil price was at $25 a barrel, that price was unsustainable. It takes the industry $60 to make it. They were selling it for 20, losing $40 a barrel, 80 or 90 million times a day. It got kind of boring. And so the industry stopped making sustaining capital investment. The oil supply shrank very rapidly, and all of a sudden the price went from 20 to 80. These are instructive, and we're going to see more moves like this. Even at today's price at $80 a barrel, we are not seeing a resumption of even sustaining capital investments by the major oil producers, much less the type of new project investment that you need to make to maintain current supplies. Also, although the oil stocks have risen, the oil stocks are still acting as though the oil price itself was $55 or $60 a barrel rather than 80. And the natural gas stocks are acting like the natural gas price is at $3 a thousand rather than $5 or $6 a thousand. So there's going to be an awful lot to talk about in New Orleans, irrespective of your interest, as long as that interest is in some way natural resource and precious metal centric.
Rick, if you look at what's happened in the oil markets over the last 2 years, one couldn't blame these companies from being a little bit hesitant, from reinvesting that, and also the continued looking tendency to look forward toward alternative sources of energy. You could see why they would be a little bit reluctant to make those big investments. Do you think that's the right thing to do, though? Should they be making these investments now?
I think the CEO of Chevron said something very instructive a couple of weeks ago. He said, to the extent that our shareholders want to invest in alternative energy, they can do so with the dividends that we earn them in the conventional oil and gas business. This is what we do for a living, and we do it well. I think that's the right point of view. I agree, Albert, that at some point in time in the future, demand for oil will at first plateau and then begin to decline. What point in time that takes place will have to do, I think, a lot with the oil price, which is to say the utility that oil produces relative to other fuels. But I think that point in time in the future is probably, I'm going to guess, 2040, 18, 20 years hence. Right. There's going to be an awful lot of money to be made between now and then. And right now, it's an awfully good business. If you look at the income statements of solvent oil companies, large and small, and you look at the amount of cash that they're generating, it's truly, truly, truly stunning, particularly when you compare it with the cash that is not being generated by their would-be competitors of other sources of energy.
I can see that point, and for the most part agree with it, but you can also see why these dinosaur companies, not referring to Chevron in particular, but Kodak as an example, stick to the guns and eventually disappear. It seems to happen to all companies. Jeff Bezos has even said that Amazon will disappear at some point. It's inevitable. I guess if you believe the runway is that long, then perhaps they're right. Is that what you believe? You believe the runway for traditional oil source?
I absolutely do. If we as a society were willing to make vast investments in the trillions, as an example, in the electrical grid, or vast investments in the electrification of the auto fleet. Remember that the market share of electric cars, even in markets like the United States that can afford it, is very, very, very small. And it's infinitesimal in the emerging and frontier markets. If we were willing to make vast investments in nuclear plants, then the demise of oil would come much more quickly. But we're not. We have a huge, huge investment as a society in the internal combustion engine and the utilization of liquid hydrocarbons for electrical generation. And these fuels are extremely efficient fuels. The energy density and the ease to use oil and gas, particularly with the trillions of dollars of capital equipment that we have in place to use them, means that even with subsidies, most other forms of energy are completely uncompetitive and will be uncompetitive until either we have made the investments as a society that we need to make to facilitate replacements, or until the efficiency of those alternatives gets smaller. If you look today, Albert, at Germany, which is probably the leader in the world of the move away from hydrocarbon energy, what you see is massive energy shortages and a 500% increase in individual consumers' power bills. Now, I understand this is an extreme example. A country that decided to rely on solar energy in the far north where the sun doesn't shine, doing things like scrapping its nuclear fleet and then running the country on nuclear power imported from France. I get that that's a strange example. But when you talk about the runway for oil and gas, I think what you have to look at is the enormous amount of capital that society has in place to utilize oil and gas and the extraordinary efficiency of oil and gas relative to other kinds of fuels. Will this last for 100 years? Absolutely not. The ascent of humankind through technology will allow us to find diverse energy sources that are ultimately cheaper than oil and gas, particularly if you find a way to price carbon. But that's going to take place in the future. The net present value of that technology at a 5% discount is zero. It has no net present value. Cash flow that you enjoy 25 years from now, discounted at 5%, has no net present value today. By contrast, oil and gas companies that are generating 30 or 35% free cash margins have huge net present value today. I get your narrative. I just think math is on my side in the near term.
Yeah. And the plan you described in Germany sounds like a perfectly legitimate government plan, if you ask me, with the expected result.
It's interesting that you mentioned government in the context of the oil industry. The biggest threat that the oil industry faces is not Elon Musk. It's the big thinkers. It's the government people who don't worry too much about the fact that what they propose is inefficient as long as it gathers votes. I don't think that you would find Exxon or Chevron, as an example, worrying too much about market conditions. I think they worry an awful lot about the whim of some nut job congressman.
It seems like at times these projections, these big thinking projections, have more to do with maybe your political ambitions or perhaps what assets happen to be on your balance sheet. And I feel like it would be hard to, you can't, I guess, believe both predictions of, as you say, like a long runway for traditional energy sources, which you might get from a Chevron, with what you're seeing from some of the big car manufacturers, where they're going to double their revenue in so many years on electric vehicle sales. Like, those things don't go together, do they?
I think that some of the promises made by the large automakers are political promises, much like the promises that you hear from Democrats and Republicans. I think probably you're being charitable, in fact, calling them promises. I would be tempted to call them lies, deliberate lies. The idea that BP is, quote, beyond petroleum, and they're going to go into alternative energy. They don't know anything about alternative energy. That's a wonderful political statement. The chance of it coming true is nil. I'm in Vancouver right now in Canada, as you know. The political leader up here decided and promised 4 years ago that, quote, the budget would balance itself. That's the same kind of statement that I think the automobile makers are making. They're making a promise about behavior in the future that allows them to continue to make money now on an efficient fuel.
Yeah, and I don't know if the market is actually buying these projections seem, extremely ambitious, even for CEOs. You told me a long time ago that you don't pay too much attention to the macro stuff, and I was just entrenched in the macro stuff back then. I still find it very interesting, but over the course of about 4 or 5 years, you finally convinced me that, that's probably not the way to go in terms of your investing pursuits. I think I've been revisiting some of the Buffett transcripts from his annual meetings, and I think Charlie Munger explained it very well. He said, the macro, in terms of macroeconomics, the macro is what you get, the micro is what you do. And I wonder, I completely agree with that. So it looks like we might get a more inflationary outlook, and part of that seems to be self-fulfilling. I mean, the factors have been there for a very long time, at least as long as Bernanke. You could even go back to Greenspan. You could make a theoretical case for inflation as far back as that. But now there's acknowledgement, and it almost seems like once people acknowledge it, then it becomes true. It's the spark. You can have gas without fire, but once people know it's there, someone lights a match. So if that That could be what we're looking at. What do you think we should be doing, though? Because we can't really rely on that necessarily. What, as investors, should we be doing? What's the micro in this case?
It depends on how old you are. If you're my age and you remember inflation in the 60s and 70s, not that this circumstance will play out the same time that one did, but what you come to expect is that people's anticipation of the future is set by their experience in the immediate past, which means that the realization of the arithmetic around inflation will come to the population slowly, despite the fact that it's true. Like they say, generals always fight the last war. We have been trained in the period 1982 to 2021, 2022, a 40-year period, that things just get better and better, that interest rates fall and fall and fall, that inflation falls, that technology improves, that equity markets go up, that home prices go up, all that kind of stuff. You may remember, Albert, that 10 years after the decade of the 70s, through the decade of the 80s, when very high real interest rates really clobbered inflation, that there were still very strong inflation fears in the economy for 10 years after the real inflation threat had passed and after the arithmetic was out of the inflation equation. I think similarly, we've been trained for 40 years not to fear inflation. And despite the fact that the arithmetic is in place, and despite the fact too that the conditions precedent for inflation, quantitative easing, debt and deficits, negative real interest rates, out of control spending, despite the fact that that's all true and ever present, people aren't aware of the fact, or aren't aware of the arithmetic, or aren't reacting to the arithmetic because their expectation of the future is set by their experience in the immediate past, not the distant past. So the first thing that I think people need to do, this is a wonderful advertisement for the New Orleans conference, is to invest in your own education, invest in your frame of mind. Invest in the fact that things do change, and although they change slowly, the change is profound. Let's explore this a bit. The demographic of the New Orleans conference has changed over time as the attendees have aged. The median age of the attendee has advanced. And savers, wealthy savers, need to ponder this piece of arithmetic. If you invest in a US 10-year treasury, the government pays you 150 basis points at present, in a currency where they acknowledge the purchasing power is declining by 550 basis points, 5.5%, which means that the government guarantees that you will lose 4% of your purchasing power compounded annually for 10 years, which is to say that at the end of the 10-year period, including the compounding, almost 2/3 of your purchasing power in an allegedly riskless asset will have gone to money heaven. Understanding that simple arithmetic is the first part to understanding inflation. In other words, you have to invest in asset classes that have the pricing power and traditionally have been good inflation hedges. That might be high quality real estate with very long fixed rate financing where the rents can rise slowly, but the cost of capital stays the same, where the delta between the rents and the cost of capital expands and protects your purchasing power. It might be traditional inflation hedges like precious metals. It might, in fact, ultimately be the S&P 500, although you're starting from a very high, I would suspect, a very high valuation point. But Buffett made the point, in fact, demonstrated the point in the 1970s that very, very high quality businesses with competitive moats around them had sufficient pricing power that they could be reasonable inflation hedges. The most important thing, however, is simply to condition your mind to expect inflation and think about the results of that. One thing that will be different this time than last time, I think, is that inflation this time and the growing realization of expectation will lead to much more volatility in equity markets than we've come to expect. First of all, because people are going to confront a reality that they aren't used to, which makes them uncomfortable, but also because the whole system is much more heavily in debt than it was in the 1970s. There's more debt on corporate balance sheets. There's much more debt on federal, state, and local balance sheets. And I would expect, in addition to inflation, that we're going to have to deal with market volatility. And that leads me to a very odd tactic. Despite the fact that your savings will erode your purchasing power, you will still need to maintain cash liquidity. You will still need to have the liquidity to take advantage of those circumstances in the market where there are liquidity squeezes and we have liquidity related market declines. I remember myself personally in 2008, which many of you will remember was a pretty ugly market decline. Because I had a lot of cash, I had both the courage and the tools to take advantage of that situation rather than merely be taken advantage of. So the mindset around inflation is very different than the mindset around a benign climate, the climate that we've been coming out of. Educating yourself, understanding that traditionally precious metals and precious metals securities have reacted well. By the way, don't go all in on any asset class in terms of including gold and silver. Remember to buy high quality businesses with moats around them, with purchasing power. Maintain some cash. All of these are important things. Understand too that, and not just in gold and silver, but in other markets, if there's an asset class that you really, really, really like, that you're really attracted to, and you've done work on it, if the prices of that sector fall precipitously, it's a good thing, not a bad thing. When the price of something that you want to own falls precipitously, you can capitalize on the work that you've already done to increase your position at better and better and better prices.
I had a question. When you talk about people being conditioned to not fear inflation, are you talking mostly about retail investors, or do you also include institutional investors and policymakers as well?
Yes and yes. Institutional investors, increasingly, there's a huge proliferation of institutional capital now. And many of these institutions are run by people who pay particular attention to their quarterly cash bonus. For them, money isn't made in the 5-year time frame or the 6-year time frame or the 7-year time frame. Their money is being made and marked to market on a quarterly basis. They make money employing other people's money. It's not their money. And they have a bias to the upside because it's all they've ever experienced in their whole career. Imagine Albert, a 40-year-old money manager. He or she came into the business after the 2008 collapse. They have no experience with trying times. They might be intrinsically smarter than you and I. They may work harder than you and I. I remember Mike Tyson famously said that everybody he ever got in a ring against had a fight plan, and that fight plan lasted until he punched him in the face. And I think that some of these institutional investors, the young ones in particular, are going to find their fight plan upset because they've never been in an economic sense with Mike Tyson. The policymakers, I don't think have any incentive to anticipate inflation because the voters don't want to contemplate inflation. The voters don't want to contemplate a circumstance where the provision of goods and services that the government provides to them might be constrained. People don't want to live within their means, particularly if they don't see themselves as paying for living within their means. So I think the policymakers are constrained both from the ignorance that comes from 40 years of benign climate, but also I think it's a job requirement. I think that somebody who is prudent and honest has no chance of getting elected.
Right. And I think your point about never being burned, Buffett says it's better to operate with a 130 IQ than to have a 150 IQ and think you're a 160. Those folks are very dangerous.
He's fun to quote.
He's the best. Okay. I know you've been thinking and talking a lot about uranium lately. So can we conclude with some thoughts on the uranium thesis and update perhaps on where we are?
You know, it's such an instructive topic for the conversation that we're having, Albert. You know that I have been urging people into uranium for 4 years. When the uranium price absolutely positively had to go up, when it was absolutely an arithmetic certainty that it had to go up, nobody cared. Nobody cared. With regards to junior uranium stocks a year ago, I was practically calling people's brokers for them. And if I was their broker, I was calling their broker for them. I was calling them, but nobody cared. When the price of uranium marched from $20 a pound to $50 a pound, which is to say, when the easy part of the move had already happened, everybody wanted to be in the uranium space. It's really, truly odd. I mean, if you were in New Orleans and went down to Bourbon Street for a dozen oysters, and the first night that you went to the oyster place, the oysters were $1 an oyster. And the next time you went to the oyster place, the prices had doubled to $2 an oyster. Would you think these were better oysters? I mean, would you be happy that something that you wanted went up in price? People buy oysters much better than they buy uranium. Now, the price of uranium has declined from, 51 or 52 down to 38. And all of a sudden, people are thinking parenthetically, these are bad oysters. I don't like oysters anymore. If you didn't like it at 20, why would you like it at 50? If you liked it at 50, why wouldn't you like it at 32? In my declining years, I've come to learn that cognitive dissonance is intelligence. If it doesn't make sense, it's because it doesn't make sense. So let's get down to your question now. Let's get away from the education and get down to the question. I believe, after a long period of study, that the real incentive price for uranium is $60, $65, $70 a pound and is rising rapidly because of inflation, because of social rents, which is to say taxation and royalties in uranium producing countries. Right now, at least in the spot market, we sell the stuff for 38 and it takes us, let's say, 60 to produce it. The arithmetic is still pretty compelling, not as compelling as it was, but still pretty compelling. In the near term, I believe that the uranium price can fall. And in the near term, I believe that the price of the uranium equities, particularly the junior uranium equities, can fall because those prices haven't fallen as much as the price of the yellow cake has fallen. So 2 years from now, 3 years from now, I think that we will likely see prices north of $70 a pound. Maybe substantially north of $70 a pound for the following reasons. If you moved the price up to 65 or 70 tomorrow, reopening mothballed construction, mothballed mines, never mind building new mines, probably takes you 2 years, even for the mines that have been well maintained and shut down, like MacArthur River and Cigar Lake in Canada. So when the price goes up, you'll get an immediate supply response. But beyond that, when you take uranium out of a mine and you put it through the fuel cycle to turn it into custom rods for a nuclear power plant, that can take a year. So if the price went up to $65 tomorrow, it could be 3 years before you would see a supply response. So what you learn in the transition from a bear market to a bull market is that the commodity price can overshoot on the upside because the industry is so capital intensive that the supply response is delayed. So if people say to me, Rick, how do you feel about the uranium business 2 years from now or 3 years from now? I say, I feel ecstatic. How do I feel about the uranium price in the next two or 3 months? I'm not so sure. I think the risk to reward parameter is good because I think the new variable in the uranium price is our own physical uranium trust, or rather our former employer's physical uranium trust. I shouldn't say ours anymore. The Sprott Physical Uranium Trust is what has changed the spot market. And frankly, the market's response to the Sprott vehicle, putting $500 million new dollars into the trust, which allowed the trust to buy so much material out of spot that they doubled the spot price, happened much more quickly than I had anticipated. I had anticipated that the Canadian listing would constrain demand. And I think it has constrained demand. I think the impending listing of that product on the New York Stock Exchange in the first or second quarter of next year will be the catalyst in the near term that the uranium price needs to go higher. What's of more importance to me, however, Albert, is that it appears now that the political wind in Japan is blowing solidly in favor of the restart of the Japanese nuclear fleet. If you look back on the uranium subject, the thing that caused a decline in the uranium price from 70 or $80 a pound down to the mid-teens was the Fukushima nuclear disaster and the idling of the Japanese nuclear fleet, the second largest nuclear fleet in the world. The delayed restart of those plants has done two things. It's constrained worldwide demand by about 20 million pounds a year, while simultaneously making very large existing Japanese inventories available for sale, decreased demand and increased supply, which had the obvious impact on price. For some period of time, the Japanese government and the big Japanese corporations have wanted to restart the nuclear fleet, but the Japanese citizenry were very distrustful of their government, surprise, surprise, and were politically opposed to restarting the nuclear fleet. Just recently, it would appear that increased burning of coal in Japan, the incredible price of liquefied seaborne natural gas in Japan, Japan's commitment, which is popular in Japan, to the carbon protocols, has meant that there's a resurgence in the popular appeal of nuclear fuels. And although Japan only has 8 or 9 reactors in place, there are permits in place now to restart 18 reactors. The increase in the pace of Japanese restarts, particularly when combined with the increasing tightness in the spot market caused by the Sprott Physical Uranium Trust, I think over the next 12 months propels the uranium price higher.
Let's say I'm going to revisit the Buffettology. Let's say that's what we get, the uranium price as you described it. Now let's talk about what we do. One thing you can't complain about, Rick, is that you can't complain you haven't had enough time to look at these companies. You've had a lot of time to ponder what you might do or who might benefit the most when the uranium price turns around. So let's share with the viewers, what are the types of things that specifically that you look at when you're evaluating these companies?
I want a company that, if it's not in production, can be in production this cycle. I want a project that has good enough infrastructure, a good enough cost structure, good enough size, and a good enough permitting environment that in this uranium cycle, it can be put in production or at least sold. What I really like are companies that generate enough cash to stay alive at $30 uranium, because it's those companies that will make the quickest money when the uranium price goes to 60 or 65. Oddly, the move in the uranium equities that we've seen in the last year is a reversal of narrative. Uranium went from either boring or hated to being loved. And the consequence of that reversal in sentiment has been that it's been the narrative stocks, which is to say the most marginal of the uranium companies, that have enjoyed the best price escalation. In the circumstance that we're in now, were people following my advice, they would be buying the larger capitalization, higher quality uranium stocks in preference to the more marginal stocks. Aditya Patanayak, who you remember well, who you used to work with together at Sprott, has put together a database of 63 companies who purport to be in the uranium business. And I would suggest to you that fully a third of those, fully half of those companies, fully 30, don't have mineralization that's economic at $60 or $65 a pound. Now, if the price of something that you don't have any of goes up, it doesn't necessarily impact your intrinsic value. So investors need to pay attention to the fact that the uranium companies that they buy have to be able to benefit, and benefit relatively quickly, from an increase in the uranium price. In other words, once again, look at the arithmetic more than you look at the narrative.
All right, Rick, I've taken enough of your time, so thank you very much. It's great to catch up with you. We will see you virtually at the New Orleans conference. Remind everyone that's October 19th to 22nd, link in the description below. Rick, I look forward to seeing you virtually there and in person as soon as possible.
I look forward to hearing your reports, both about the wonderful conference and, of course, about the wonderful food that you're going to eat after the conference. I hope that you'll have at least 2 dozen oysters and think of me while you're doing it and report to me how much fun you had doing it.
I will. And I have to admit, while you were giving your uranium oyster analogy, I couldn't help but think that some people, had they got sick on $50 uranium, might be a little gun shy, even with the price down. I don't know if you've had that experience. It is unpleasant, and I never have oysters before I travel anymore for that reason, or before speaking.
Probably better, of course, to follow the analogy to its thick end. Better to do that than eat the uranium, probably. So,
All right. Thank you very much, Rick.
thank you.